Hey, Kyle here with whenthehouseyoulove.com. As the median home price continues to increase, you might be wondering, how much income do I need to actually qualify for a loan? And how in the world does a lender figure out how much home you can afford, right? You're looking to apply, you go talk to a lender and they're like, here, you can afford this much. We'll give you a loan for this max purchase price. Well, where in the world did they get that number? I'm going to show you all the math and what goes on behind the scenes so you can understand where they're coming up with this number so you can help change it if you need that to increase. All right. And so I'm going to show you, based on the four main loan types, conventional, FHA, VA, and USDA, the minimum income needed to afford the median home price, which is $347,500 at the time of the recording of this video. So here's the scenario that we'll be walking through. We're, of course, going to do the median home price right now. We're going to do a 3% rate. So each loan is probably going to have a different interest rate with it. We're just going to try to keep it all the same 3% interest rate across the board. We're also going to do minimum down payments. So conventional 3% down, FHA 3.5% down, VA 0% down, and USDA 0% down. And then we'll do 1.1% in annual property taxes, 0.35% in homeowners insurance. We'll do zero homeowners association fees, and then $500 a month in debt. And so these monthly debts, minimum monthly debt payments, are things like a car loan, credit cards, student loans. It does not include rent, utilities, or any other types of expenses or bills like that. And I'll explain why here in a minute. And so again, we're going to be using $347,500. Something interesting to note is that the median across all home prices is the $347,500. However, depending on the loan type, the median actually changes. So with conventional loans, the median price for people purchasing with conventional is $386.6. With FHA, it's $255.4. With VA, it's $324.3. And USDA, unfortunately, doesn't have any data on this, but we'll cover a USDA loan as well. So how do lenders find your maximum purchase price? It's mainly through this number called the debt to income ratio. Basically, it's a percentage that says how much of your monthly gross income is debt payments, is the minimum monthly debt payments. And this is going to be adjusted by the risk profile. So we're going to be looking at the maximum. Each loan has its own maximum debt to income ratio as a percentage. However, if your credit score is lower, if the loan is riskier to the lender, then that maximum is actually going to be lower for you. So we're going to assume the risk profile is at its best. Maybe you have an extremely high credit score and there are no other risk profiles in the loan. And so we're going to just look at the maximum debt to income ratio so we can see the absolute minimum income required here. All right. And so there are two different debt to income ratios. There's a front end and a back end. Front end debt to income ratio right here is the monthly housing payment divided by the monthly gross income. And I'll explain why it's gross here in a minute. The back end debt to income ratio is the same, except we're going to add in there the monthly minimum debt payments. And so the lender basically wants to see what portion of your monthly income is being used towards either the future mortgage payment or the future mortgage payment plus the debts that you're already paying minimum monthly. So why in the world do they use gross income, right? We only get to take home our after tax pay and use those dollars. So why gross? The reason why lenders want to use gross is because net income can be manipulated, and then that wouldn't actually be fair for everybody. With the gross income, lenders have already factored in taxes into the debt to income ratios. Okay, so they've already factored in the taxes that you pay. If we were just looking at net income, it'd be very easy for somebody to manipulate their W-4 to change withholdings with how much taxes they are taken out. Or there's other withholdings that are included inside of a pay stub that you might have. Things like garnishments or child support or retirement accounts. There are those things in there as well. So you're using net income when you figure out if you can afford a home, not what a lender does to see how much loan they'll give back to you. The debt to income is what the lender uses to determine your risk of paying back the loan. Okay, and so it's very, very important to remember it's not what you should use to determine if you can afford a home. You affording a home is about your budget and what you're comfortable paying every single month, not what the lender tells you. All right, you never want to go with what the lender just says. Here, you can afford this much. The lender is only looking at how risky it is to give you a certain amount of money, a maximum loan. It's up to you to decide, should I take this on? Is this a good decision or not? Because only you know your financials. Only you know the money that you have every single month that you're using and what it's going towards. So a lender is not your financial advisor. Please don't make them your financial advisor, because they are not. All they're doing is they're giving you a loan, and they're telling you how risky they think that loan is. And they're going to say, this is what we're willing to give to you. Just because they're willing to give it to you doesn't mean you should take it. And so what we're going to do is we're going to look at maximizing the debt to income ratio as an exercise, not as a recommendation. I'm not recommending you do this. What I'm doing is I want to show you the maximum debt to income ratio so we can see the minimum income needed for each of these loans, again, as an exercise here. So next step is go ahead and choose your loan. All four on screen: conventional, FHA, VA, USDA. Pick your loan, and I'm going to walk you through the math to figure out what is the minimum income needed for each loan type.